Tunataka kuifanya exam the way you're supposed to do it in exam. That is how I want us to do it. The way it should be approached in exam. So it says, the following draft financial statement was extracted from the financial records of Malum Limited, a public limited entity with comparative figures. So right there, Malum Limited, statement of cash flow. For the year ended we are not going to waste any time. So in exam, this is how you're supposed to. Ukishaangalia swali unaona hii ni cash flow. So you don't waste time reading. It's a complete waste of time. You know the format. So you go to the financials. You go to the financials. They are empowerments. Like that. Then your cash flow, I know, and you all know, it starts with operating activities. So operating activities. Operating activities. How it that way? You be smart. Instead of working. Unaweza fanya the workings kwa mchana. By the time you are finishing the working, time is over. So at least you write and get something. So have their operating activities. Then we always start with profit before tax. How much are you saying as your profit before tax? Is that P&L? Before even we start reading, profit before tax. Profit before tax. How much? I'm waiting for the figures from your side so that we move together. Current 8190. Someone to confirm Rose 8190. Profit before tax 8190. Already you can mark. So I don't advocate for students who find workings from Tiani. They are not marked. Those workings are not marked. So wake up a profit before tax. At least you have something. Then you say adjust for. Once you write adjust for, what follows is always depreciation. So where I get to depreciation, then we will see what happens thereafter. So let's just start reading. So we can read. When we come across anything, in fact, ukishaandika depreciation, andika amortization. In case, kama hakuna tutaweka dash, amortization. So as we start reading, when we get depreciation, tunaweka kama hakuna is when I will go and do a working. So we start with note 1, students. Malum Limited acquired some new plants during the year at a cost of 18 from a finance company. An arrangement was made at the date of acquisition for the liability for the plant to be settled by Malum Limited, issuing at par 10% loan note dated 2025 to the finance company. The value by which the loan note exceeded the liability for the plant was received from the finance company in cash. You remember PPE. PPE does not affect this, it will affect investing. So hold it for now. Next, the company motor vehicle held fleet, what is that, with a cost of 2630 and accumulated depreciation of 1165 was disposed of during the year for cash proceeds of 1810. The profit on disposal has been included in other operating expenses. So gain on disposal, that is an income which you are going to subtract. So how do you get gain on disposal? You take the amount you have received, the proceeds, the amount you received minus the net book value, not cost. So they received, it was disposed at 1810 minus the net book value. Net book value will be 2630, which was the cost, minus the accumulated depreciation, which is 1165. So we normally compare what you have received versus the net book value. So net book value is cost minus accumulated depreciation. So can you give me that gain? The gain on disposal. Kindly. Chop chop. Gain on disposal. Work with the bracket first so that we observe. Rows 345. Someone to confirm the same. Rows 345. Someone to confirm that the gain is 345. Joyce has confirmed. So this gain 345. That one you subtract. It is not an operating income. So we subtract. Number two, depreciation charge on property, plant, and equipment during the year was 5490 and was included in the cost of sales, 5490. Depreciation for the year, this time around it has been provided. So you add back 5490. This is the approach you give in exam. Kindly. Higher. Number 3, intangible assets were amortized during the year and amortization charge to profit or loss amounted to 540. So they are saying there was amortization of intangible assets, which amounted to 540. So you come here and say amortization, that is 540. You add back. We are proceeding. Note number 4. During the year, Malum Limited made a bonus issue of ordinary shares. Ordinary shares will go to financing. We don't want those things right now. Now, I want us to go back to the P&L. P&L, you check between revenue and profit before tax. You check this space. Any item in this space which is not admin, cost of sales, or distribution, we don't want. So you check them out. They are not part of operations. So we start from bottom up. So profit before tax, when you are climbing up, there is finance cost. Start. So finance cost, that is not an operating expense. They are subtracted, so you add back 705. Other operating expenses are other operating income, government grant, hakuna. So government grant, there is nothing like that. Government grant, 750. You remove. It is not an operating income. We don't generate that on daily operations. The only operating income we know is this one, the revenue itself. Going up, gross cost of sales revenue, those ones are okay. We are done with adjustments. Can you give me now the cash flow before working capital changes? So cash flow before working capital changes. How much will you get? Cash flow before working capital changes. Somebody with an answer? Rose 13,830. Someone to confirm? Rose 13,830. Mildred confirmed 13,830. Then now we bring working capital. Working capital. So working capital, you check increase or decrease in inventory, receivables, payables. So I want us to go one by one. We start with inventory. Inventory, 11, it went to 13. That is an increase. Tell me how much. So increase in inventory. Just tell me the figure. 13 minus the 11. What do you get? Hapo tunafaa tupite haraka sana. It's just subtracting and giving me the answer. Is an increase of how much? Somebody? You have taken long there. Gross 1855. I hope that is okay. You subtract. Increase in stock means you are buying more. Nobody confirmed that figure. Nataka tupeane hizo answers chap. Ukisonga. Mtu akiweka una confirm. Good. Trade receivables, 7, it went to 9. That is an increase. So increase in receivables. The difference, it has increased by how much? It has increased by how much? Receivables went up, Paris, 2150. You subtract, Mildred confirmed. Payables, teremuka huko chini kwa payables. Payables, 7 to 10, increase. So increase in payables. An increase of how much? Payables from 7 to 10, 21, which figure should it be? $24.30, Mildred. So that one you add. Confirmed. Therefore, cash generated from operations. Cash generated from operations. Cash generated from operations will be 13,830. Adjust those three. I'm adding payables. You know payables, the creditors. When the creditors balance is going up, it means we uko na pesa na utaki kulipa. Unasema I'll pay. Those are small things. I will pay. So can you adjust and give me that answer kindly? Ross is getting 1575. Ross, yes, ni kidogo sana. 13 plus 2 is 15. Ross, hiyo ni mimi naona hiyo ikiwa kidogo. Because in 13,000, this is 13,000. 13,000 minus this, inafaa ikuwe kitu or over 10,000 plus. Karibu 12. Are you working from 13? You know you're supposed to have from 13, 830 minus that plus 24. 12,255. Hiyo ndio watu wamepata. 12,255. Like that. Then now we go for tax paid and interest paid. Interest, niliwaambia unakuja tu unachukua hii. This finance cost here 705 peleka huko. So I want to start with the tax though, then I will bring this interest. So tax paid, hata hiyo tax means ili kupoteza wakati huko nje. Be ready to work it here. You will be moving, but okay. Are you comfortable? Are you people comfortable with the approach I've taken with this? Or you want the workings, then presentation? Are you comfortable how we are moving? Najua nyinyi ndio mnafahamu ni I'm comfortable with any. Joyce says this one is okay. Karis, kila mtu sawa. Then that is okay. Those who have confirmed is a representative of others. So tax paid. Ana hiyo tax stakani kwa mtihani mwende mwezi time huko kutangatanga huu pana staki hiyo story. Tax paid, there's a way you can do it without wasting time. There's a way you can do it without wasting time with workings. This is how you do it. You check the deferred and current taxes at the beginning of the year. You compare with the closing at the end. Closing at the end. So that decrease, the decrease is what has been paid. So this is how you do it. Check deferred. Deferred tax at the end. Let me just ask for formality to confirm that we are together. How much is deferred at the end of the year? Deferred tax at the end, which you can see. Deferred tax at the end, which you can see. Rows 1920 and others 1920. Oh, that's at the end. Yes, 1920, 1920. Beginning was 810. I hope everyone sees that. Under current liabilities. So you come and say tax paid. So you take opening. We open with 810 for deferred plus current opening, current check under current liabilities. 1 to 2775. 2775. So at the beginning, we had these two liabilities. During the year, check P&L. How much were we charged by the exam? How much were we charged for the year in the profit account? I want to check whether you can spot it. How much were we charged in the profit account? How much? Rows 2655. Let me check. Income tax 2655. Daniel, yes, everyone sees that. 2655. It means when we are closing the year, if there is no tax we pay, kama tujalipa tax yoyote, it should be this total. Can you add for me this plus this plus this? Kama kuna tax ijalipwa, that should be the total. So if we check the closing, then we get the same, then means no tax paid. So what is this sum? So this one you can even indicate in your book. This is D to stand for deferred, C for current, P and L for the year. So total tax should be how much? Mwiti, 6250. Total tax should be 6250. But look at Mr. Examiner. Minus closing, according to the examiner, instead of 6250, they closed with 1920 plus current, which is 2685. So they closed with how much? We are going to get the difference. They closed with how much? This plus this. This plus this. How much? How much? Okay, you have taken long. 16. Hey, Mwiti and John, you have clashed. John is giving me 1635, which is giving me 1645. Rose is figure 62. Which is which? Aya, sasa, we are starting afresh. Things are not good here. Figures zimechanganyika. So mnatumia comma. Add the first one, uniweke, then comma, the second one. Then we are going to subtract the two. The first one is ya kwanza is 6240. So the first one is 6240. The second one, 1635. The second one is 1630. 19 plus 26. The second one is 1920 plus 2685. Should be how much? Okay. 4605. Good. So the difference is the tax paid. So how much, the variance is the one which is 1635. Okay. So people had already calculated. So tax paid is 1635. I hope you have understood how we have gone through that. Instead ya kuwasumbua na workings 800. So you take deferred, the beginning deferred, beginning current for the year. You add, subtract the closing deferred, closing current. So tax paid is 1635. Then for interest, this one, where's interest? Finance cost, this 705, subtract it there. Interest paid 705. Quisha. Give me that answer, call it A. So take 12 minus this minus that. $99.15, Daniel. Positive. So Daniel is giving me 99.15 positive. So we are done with operations. Unless you have a question, I want us to go to investing. Unless you have a question, I want us to go to investing. So it seems there is no question. So I want us to go to investing activities. Investing activities. So investing, one, you go to non-current assets, please. Let's go to non-current assets. Investing mostly is on non-current assets. So on the non-current assets, you are seeing property, plant, and equipment. Property, plant, and equipment, two things. So ukifika kwa cash flow, wewe fika tu hapo na uandike zitakuwa. So right here, cash on disposal, then cash paid to acquire PPE, property, plant, and equipment. So when you get to property, plant, and equipment in cash flow, those two, then from experience, the examiner will give you one of these two. The examiner will give you one. Then you will reconcile PP account to get the one which you have not been given. So your duty, first of all, is to write those two. Then you check across to confirm the one you have been given. You post it first. At least after examiner can stop. You have posted something and it will be marked. Then we are going now to reconcile PP account, property, plant, and equipment account, to determine the other one which you have not been given. So of the two, we were given the first one, disposal. Check note 2. Check additional information number 2. Whichever. The company motor vehicle with a cost of 2630 and accumulated depreciation of that was disposed of for the year for a cash proceed of 1810. Cash proceed of 1810. So we disposed and we got 1810. Don't even waste your time to check cash paid to acquire. We must do a reconciliation. So hapo hizi epuka, hiyo lazima ufanye. So have a working down there. So I will just delete this and do working to Kisonga Evo. So have a working somewhere, not down, somewhere in a separate space. Not down where you're doing presentation, in a separate space. So property, plant, and equipment. Have that. Nataka tuitandike vizuri. Pole pole. Tutaitandika vizuri without problems. We are now checking acquisition. So you will start by saying balance brought down. So can you check PP at the beginning of the year? So at the beginning, PP was 27 for 50. You can see it's 27 for 50. There is something I always forget, and before I go, I want us to check the revaluation. In our yesterday question, revaluation related to an item which was disposed. In this question, they have not mentioned revaluation on disposal. So if there is a revaluation, we bring it here. So check under equity, check under equity, check under equity, under your equity, check under equity. When you check equity, you will be able to see revaluation surplus of 2550. You add it to the asset. There was no revaluation at the beginning, at the end. So it means the assets which were there were revalued. Unlike ile swali ya jana, there was revaluation beginning, mwisho haiko. It means ilienda na asset imeuzwa. But here it was not there, then it is there. So you increase the assets. So you say here, revaluation surplus is 2550. From there, we go to the additional information. One by one. Number one, Malum Limited acquired some new plant during the year at a cost of 18 from a finance company. Okay, from a finance company. An arrangement was made at the date of acquisition for the liability for the plant to be settled by Malum Limited, issuing at par 10% loan note to the finance company. The value of the loan note exceeded, So there was one which was acquired through loan notes. So through the loan notes, we acquired at a cost of 18. You know, loan note, you only loan, hakuna kitu hapo. So there is no cash paid. Though it was acquired, but it is not cash acquisition. Correct. Let's go to the next note. Next note was disposal. So let's disposal. Disposal, you dispose at net book value. So it was 2630 minus accumulated depreciation of 1165. We did it somewhere in Esau. Can you give me that net book value? 2630 minus 1165. Tell me what you are getting. Somebody? What do you get? You get 1465. Thank you. Next note, depreciation 5490. Less depreciation 5490. Kwisha, hakuna kitu ingine. Can you adjust for me that value? Kindly adjust for me that value. Adjust for me that value. is how much? 24,845. Skip one line. Skip one line. Balance carried down. Examiner is giving us in the balance sheet to be 36,300. So this increase from 24 to 36 is what they acquired. So acquisition, the increase is how much? So this is the BF, balancing figure. How much is the BF? Somebody? 11,455 rows. So that one is like a working one. You can write working one, 11,455. That is cash outflow. 11,455. So that is cash outflow. That is what they were not giving us. That is what they were not giving us. Higher. Check the next non-current asset. Check the next non-current asset. The next non-current asset is what? Let me see. Intangible assets. Beginning, intangible asset was 6150. Nada kulikuwa na amortization. Hapo note number 3. There was amortization of 540. Then finally, the value went up to 67. From 61 to 67, acquisition straight. So I hapa. Acquisition of intangibles. Kama unataka kuandika intangible assets, unaweza kuhamia hapo kwa intangible, but sasa wasema intangibles. Acquisition of intangibles. I don't need a working, though it requires a working, but if we pretend to be smart, you don't need. You just check, closing is 6750 minus 6150, but 6150 there was amortization in note 3, amortization of 540. So the value was even supposed to be less, but it went up to 67. That is acquisition. They acquired more intangible assets. Of how much? Kindly check for me. Check for me and tell me what you are getting. $11.40. Thank you. That is cash outflow. So mostly in a hapo, mambo ya investing is about non-current asset. But in a question where you have things like government grants mostly they give to finance acquisition of these assets. So if government grant is there, please check. If it's related to assets, then it comes to investing. So let's check. There was a note, kidogo, government grant. Sasa government grant ilikuwa wapi? Depreciation, the profit, the finance company. Haikusemwa, lakini check your non-current liabilities. Check your non-current liabilities. Check your non-current liabilities. And the current as well. So when you check the liabilities, you know I told you a grant is a liability. Kama hujatumia. So there is government. Let this one be our working too. Government grants. Government grants. So government grant balance brought down both current and deferred. So deferred, which it was long-term, and non-current liabilities. Government grant long-term, I'm seeing 24. Current, I'm seeing Is the last item 600? Meaning this is 3,000. Please confirm. Kama hujaona figure, please let me know so that we show you where they're coming from. I don't want people to copy. I don't want people to copy. It seems people are okay. Silence from your side means people are okay. Good. Now, at the beginning, we had a liability of 3,000. Check your profit account, P&L. Check P&L. In P&L, other operating income, government grant. So there is an income of 750. So grant income, P&L. There was a grant income of 750. So this is an income. Utilize this income to reduce the liabilities. You cannot add income to liabilities because these ones are liabilities. So you subtract the income from the liabilities. It means closing, we are expecting 2250. But your examiner is saying closing. Your examiner is saying closing is 3150 plus current 2680. No. 810. So what is 3150 plus 810? 3150 plus 810. That one comes to how much? 39. That is 3960. 3960. So it means we received more government grants. We got more government grants. So grants received, balancing figure, that increase from 22 to 39. How much is that? How much is that? $1,710. So you bring it here. Grant received $1,710. We are done. Call it B, whatever you get. So give me that figure, then call it B. Your B will be how much? Your B? So 16, baada kidogo, negative 9075. 9075. So somebody was asking, kidogo too, I check back. Daniel, 600 imetoka wapi? Baadaye nimeona umenipea answer mahali ama umejicorrect. Daniel, have you corrected yourself? Ama sijaona answer from Daniel. Daniel, umeiona? Or we try to help you out. Have you seen? Alright, so balance brought down, deferred, check deferred beginning, Daniel, 24, current, sorry, why am I using the word deferred? For the government grants, brought down, check brought down under non-current liabilities. Non-current, I hope you can see 24, and the current liabilities, this. So we had a total liability of this one here. Then there was grant income of 750, but we cannot add income to a liability, so we utilize this to reduce. Then closing, non-current 31, 810 current. That I hope umeielewa sasa. When you are following with the paper with me, you must. Good. So let's go to financing. Let's go to financing now. Let's go to financing. Financing activities. Financing. Financing ni maneno ya shares. Shares, so tunaenda kwa equity. Let's go to equity. Let's go to equity. So under equity, let's do a working. Uko kwenye unafanya working zako. Sema ordinary share capital. Ordinary share capital. Ordinary share capital. So ordinary share capital, stay balance brought down. Balance brought down. Balance brought down. Ordinary, combine it with share premium. Combine the two. So it is 6,000 plus 1050. That is 7050. Opening. Please check keenly. Opening, ordinary, and share premium. Share premium and ordinary are just the same thing. So you add the two at the beginning. If there were no stories, I just compare with the closing. I check whether these people issued shares. But there was note number 4. Check note 4, please. Note 4. Check note number 4. Soma hiyo note 4 yote. The last note, I think is note 5 or whichever. The last note. Where we are doing the last note. Check the last note. So the last note, they said, during the year, Maluk Limited made a bonus issue of 1 ordinary share for every 1 share for every of shares of 1 new share for every 10 held, utilizing the share premium account. That note is irrelevant because bonus is going to be 1/10 times ordinary. Ordinary is this one here. So times 6,000. This one gives you 600. Be attentive because I know here you're going to ask me a question. So through the bonus, they got 600. But they utilized which account? They utilized share premium account. So they increased the ordinary with 6, then you need to reduce the premium again with 6. So it is 6 minus the 6, which is 0. There is nothing. Because you are increasing ordinary with 6, then they have said we utilize share premium. So it means you increase this by 6, then reduce this by 6. So there is nothing you have done. There is nothing there, 0. Balance carried down. Check closing. Closing is 75 plus 1350. That is 8850. So the increase from 7050 to 88, they issued. So issue of shares. Balancing figure. How much did they issue? From 70 to 88. So they issued what? 1,800. So cash on issue of new shares. New shares, 1,800. 1,800. That is 1,800. That is 1,800. We are almost. Go to the next item under equity. Revaluation tulimalizana mambo ya revaluation wachana nayo. The next item is retained earnings. Retained earnings will help you to get dividends. We are supposed to do our working, but I'm not doing that. Come here and say dividends. Dividends paid. So write that way. Dividends paid. It's something simple. To know that these people paid dividends, check their profit at the beginning. Check profit at the beginning. Retained earnings at the start of the year was 25,980. 25,980 plus 25,980 plus profit for the year. So check P&L. Check P&L. Whatever mambo ya comprehensive. Go to profit for the year. You will be able to see 5535. 5535. In the profit account, kindly check. In the profit account, kindly check. I hope you can see it. So our total profit should be the opening retained plus for the year. But examiner is saying closing retained earnings, we closed with 28. So 28,065. Yesterday we never got dividends, but because 25 plus 5 is almost 30. So retained profit went down. So decrease in retained profit is dividends. In your book, say brought down, P&L carried down. So if there is no dividend, when you add opening plus during the year, it should give you the closing, but closing has gone down. To how much? Somebody? It has decreased by how much? That decrease is the dividends they are paying. Rose is getting 34, 50. Rose is taking out 20, almost 30. Confirm 34, 50. You subtract. So camera. So equity is over. Equity is over. Let's check. Let us check anything remaining at an non-current. Non-current is the 10% loan note. 10%, Joseph, before I proceed, Joseph has a small question there. Allow me to handle Kidogo. Joseph is asking, when there is a bonus issue utilizing share premium, should it be treated that way? Because bonus must be financed from somewhere. So you have to reduce the account where it is coming from. Mostly, it is financed from two accounts. If it is not from share premium, you'll find it being financed from revaluation. So in this question, from revaluation, I would have interfered with revaluation when I was doing PPA. So here, they are utilizing share premium. So it means I'm going to increase the 6, then I reduce the premium. So there is no effect at all. So minor, that is how it's supposed to be treated. There will be no effect because you are increasing this, then you're supposed to decrease the premium. But if it was being from revaluation, Ningeleta is 6 straight because it is not affecting the premium. So Joseph, that's how it's supposed to be treated. If you have more questions, you will bring up. The only one item remaining, so we ignore the difference that is remaining. Which difference? Joseph, which difference? Because I don't see any difference. So the whole amount is being financed by that account. 1050 less 600. Why do 1050? Yes, 1050 less 600, which is true. 1050 minus 6, then 6 plus 6. So the net effect itakuwa, you know, inside the 7050, maana nini kidogo tu. Inside the 7050, so it means actually kwa hivi, you know 7050 has this plus this. So increase 7050 by 600, then again less the 600. So the way you are saying less 1050 minus this, 6 plus this, it will come back to the same figure. I hope umeona what has happened there. Somebody will decide to bring 6, then again minus 6. So it will be 0. Oh, good. That is good. So what is remaining is the 10% loan. Please, there is the 10% loan. There is the 10% loan. So loan, at the beginning it was 5250. Please check to confirm. Other than current liabilities. Then these people issued another loan. Check note number 1. When they were acquiring a certain property, I don't know if it was which plant, in note 1, they acquired another one of 18 to finance the acquisition of plant. So it means to check closing, can you add for me before even I start? 5250, because it can tally. 5250 comes. 5250 plus 1800 comes to how much? 5250 plus 1800. What do you get when you add the two? 1800 is the one in note 1. It comes to 7050. These people closed with a loan of 82. They issued more loan because they closed with 8250. So they issued loan of how much? Get me the difference. So issue of 10% loan notes will be 8250 minus 5250 plus 1800. So the issued loan worth was 1200. Quisha, there is nothing. Can you add, then call it C? Add, then call it C. So Daniel is getting negative 450, which I think is true because this plus this is 3000. So minus 450. So give me the net cash flow. Net cash flow will be A plus B plus C. Please give me the net position. Hello. Hello. People are getting positive 390. I bring cash and cash equivalents. Brought down. Have that mpangilio. We check our reconciliation. Then we see whether we are fine or not. So in this question, the cash and cash equivalent, hakuna mambo ya overdraft, nini. Tulipewa. Check your balance sheet. In the balance sheet under current assets, you were given. Brought down was 510. 510. Okay. 390 plus 510. It is giving us the current down. Their current down is 900. It is reconciling. It is reconciling. Yes, people are saying it is reconciling. So we are accurate. Very much accurate. Mimi mambo ya cash flow tumeachia hapo. You revise with those two thoroughly. Hata hizo tu mko nazo hapa, kuna swali lingine. Cash flow yenye iko kwa hiyo pepa kama ipo ni ya group. Group ilitolewa kwa new syllabus. We don't do cash flow for group. Nowadays we do cash flow for published, which is what we are doing here. So just we kila siku ukitaka kufanya cash flow, you just use those two. Then you will be safe. But what I can assure you 100% without lies for your preparation, expect group versus cash flow, or group versus published. Each category is 40 marks. 40 marks. 2 questions. Group is compulsory. So group is compulsory. That one must be there. So it is either it will be group on its own with the cash flow on its own, or group on its own with the published. So which combination? Right now you know where the things are headed. Which combination will you prefer? Group with published or group with cash flow? From what you have seen, because now we have done them, the 3 of them. Which combination will you prefer? Let me see from my students and take up or take up and photo here. So wacha tuone the best combination. To Rose will prefer combination of group and the cash flow. Jacinta, the same. Zach will prefer group and published. Karen will prefer group and published. Joseph, group and published. Daniel, group and cash flow. Joy, group and cash flow. Okay. Now, since we are aware that these three, of the three, two must be there. No, group compulsory. Of these two, one must be there. Just uziweke zikuwe 70-70. So ile effort unapea cash flow mingi ati nini ni cash flow. Just try to balance all of them. Published ikikuja uko sawa. Cash flow ikikuja uko sawa. So balance those two. Balance those two. So that zikikuja you are safe. Nataka group mtu wa mwisho kabisa apate kitu kama 17 because ni kitu ngumu. These two zikikuja mtu wa mwisho apate 15. 17 plus 15 that is 32. 32 over 40 iko sawa sana because we are only dealing with 18 marks. Only 18 upite hiyo mtihani. 18 those are 2 questions. So the remaining 3 questions kwani hizo remaining sasa zitakuwa rahisi. Farming, agriculture is there. Unaweza leta agriculture. Upite agriculture unaweza pata 20. Mpaka useme sasa ufanye hizo zingine. But don't try that. You must do all the questions. So now let those things rest there. Let those things rest there. I've shared with you some notes on our next topic. Some notes on our next topic. Our next topic is a very funny topic, which some teachers even prefer not to teach because it's a matter of cramming formulas, ratios, ratio analysis. Right there, topic, ratio analysis. Ratio analysis. Write that topic there. After ratios will not take long. Ratios haina maneno mingi. I want to take this class, the remaining minutes, to discuss all those notes. If you get time, andika, kama una time you can print. We try to solve them tomorrow. Tuone kama tunaweza fanya kesho. Maswali moja mbili. Ukitaka kuisha ishe. Sunday we start on the other topic. So after this, we are remaining with the branch and the partnership only. Hizo theory mtasoma. Those are the only remaining topics after this. Tutamaliza vizuri sana. So ratio analysis. Open the notes I've shared. There is the first page and the other pages down there. So open the first one. The first one is analyzing financial statements. Actually, that's how it should be. That topic should read like that, not rush. Analyzing, analysis. Actually, analysis of financial statements. That's how it should be. Analysis of financial statements. Analysis of financial statements. So let's read. Let's just brush through it so that I don't just come here tomorrow to start questions. Financial statements may be analyzed using either of the following approaches. So we have common size approach. We have financial ratios approach. So let's start with the common size approach. Common size analysis, also referred to as vertical analysis, is a tool that financial managers uses to analyze the financial statements. It evaluates financial statements by expressing each line item as a percentage of the base amount for that period. The analysis helps to understand the impact of each item in the financial statements and its contribution to the resulting figure. The technique can be used to analyze the primary financial statements, i.e., that is the balance sheet, income statement, and cash flow statements. In the balance sheet, the common base item to which other line items are expressed is total assets, while the income statement, it is the total revenue. Common size analysis is computed using the following formula. You take the percentage of the base, which is the amount of individual, over what we are saying, when you're using the common size, also know that this topic is what made this unit to change the name. This unit was all through called financial reporting, FR. Then it changed to FRA. That A was because of this topic, analysis. And since from the date it came, it has never missed an exam. So the probability of it missing is 0. The probability of it missing is 0. The worst they did last semester, I just checked when we took the break, the worst they did is to break the theory. Otherwise, it should always be there. All right, so in common size, what happens? Very easy, it's very easy. You check, if you are analyzing balance sheet, every item in the balance sheet, you express as a percentage of the total assets, everything. So if you are doing inventory, you check the value of inventory, if it is 60, over total assets, if it is 180 times 100%. Then you give us in form of percentage. So you check the contribution of each item to that balance sheet as a percentage of the total assets. So when you are told by the examiner to carry out common size analysis to the balance sheet, then every item in the balance sheet is expressed as a percentage of the total assets. When using the profit and loss account, when you are carrying out common size analysis to the balance sheet, then, sorry, not balance sheet, to the P&L, then the base, you express every item in the profit and loss account as a fraction of revenue, as a fraction of revenue. So revenue is the base item. Revenue is the base item for P&L. So when we'll be doing common size analysis, for balance sheet, every item is expressed as a fraction of total assets. For P&L, every item is expressed as a fraction of revenue. Please take notes. So common size analysis can be conducted in 2 ways. We have vertical analysis and horizontal. So vertical refers to the analysis of specific line items in relation to the base item within the same financial period. So when you are comparing the same financial year, that is a vertical analysis. Come on, in 2022, you are expressing everything as a fraction of total assets and all total revenue for 2022. That is called vertical. Horizontal, different periods or different entities. So when you are comparing for 2022 as a fraction of 2021, that is horizontal, or different entities, that is horizontal analysis. Balance sheets, common size. Here I've already said what it is. Income statement, that is the P&L. I've also said what it is. Importance of common size, those ones will just write and read. We go to financial ratios approach. Financial ratios, I don't know kama mmefanya when you wanafanya FM, iko pia, this topic is also in FM, but FM unafanya hii ya financial ratio analysis. So financial ratios can be classified into 5. We have investors, which are also known as valuation ratios, liquidity ratios, leverage stroke gearing ratios, profitability ratios, activity or efficiency ratios. After class, there's another typed handout I'm going to share with you after this class, which has all those ratios. But there are some very key ratios. Before you know all those others, there are key ratios I want you to master. And even if you want, you can only master those ones. They will help you big time. The liquidity, profitability, and activity. If examiner examines five ratios in the exam, 3 will be liquidity, profitability, and activity. So liquidity, these are the ratios which indicate the ability of a company to meet its short-term financial obligations. So they include current ratio. So current ratio, the way the name says, is current assets over current liabilities. The recommended ideal is always 2:1. Your current assets should be twice your current liabilities. Then quick ratio is the acid test. It's also known as the acid test. So quick, you just take current assets minus inventory. So the formula of quick ratio is the same as current ratio. The only issue is that stock in the current asset is not quick moving. So we always subtract inventory. Ideal is also 2:1. Cash ratio is not very common. Profitability, these are ratios which indicate the ability of a company to generate returns in relation to sales or investments. So for profitability, if examiner tells you in exam to calculate at least 3 profitability, the common ones, there are many profitability, but the common ones which you have to know, 1, gross profit margin. Gross profit margin, you just take the gross profit over sales times 100. Gross profit markup is gross profit over cost of sales. Net profit margin, you take net profit over sales. Return on capital employed, ROCE, you take operating profit. Operating profit is profit before interest and tax. You divide by the net assets. Net assets in this case will be the total assets minus current liabilities. Total assets minus current liabilities. So those are profitability. Then activity or efficiency ratios. These are ratios that indicate the efficiency by which the company utilizes its resources to generate their revenue. They include inventory turnover ratio. So inventory turnover, easy formula to cram to, at no option. You take cost of sales over the average inventory. Trade receivable turnover, you take amount of credit sales. Tukifanya maswali kama 2-3 itaingia tu. You take credit sales over average receivables. Your answer should be X times. You know this is turnover. How many times? Receivable collection period, do the reciprocal of turnover. Reciprocal of turnover. So you just take the average receivable over the annual credit sales. But this is in form of days. You multiply by 365 days. Then trade payable turnover. Ukitaka kujua trade payable turnover, wewe master hiyo receivable turnover. They are the same, only the wording changes. So you take annual credit, instead of credit sales, here you talk of credit purchases. Average receivable, you put there average payables. Then trade payables, repayment period, do the reciprocal of that. So nataka sana mcheze na hapo, that number 3, the activity or efficiency ratios, hapo wanapenda sana. Just know how to play around with them. NB, average is equals to opening plus closing divided by 2. Hiyo kitu wametoa. There's an argument on how to go about the average. So don't take opening plus closing divided by 2. Just take for that specific year. Because they are saying stock is an asset which should not be divided. So it was ruled out. I think they used it to be 2021, 2022. We no longer divide those items by 2. So anything average, just pick for that year. Then last sitting, there was a question. Let me check this question before we wind up. I want you to wind up so that you can, when you're on a time, uandike, when you're trying to uandika or print. Then I'm also sharing another handout with all other ratios. Last sitting, there was a question on ratios, but in theory, check question 1C. Question 1C. Summarize 5 limitations of ratios in analyzing financial performance. Limitations of ratios. So in the handout I'm going to share, they are there, but there is the theory handout. And I want to ask someone, Rachel, I want you to take the theory handout you post, because I know people like Dixon came the other day, they don't have that handout. I gave you all the theory solutions in your group. So if you check question 1 in that handout, I gave you, because I solved for you all those theories, they are there. So Rachel, after this, kindly share that theory solution. You get to read the limitations, then also check the advantages. Somebody can ask you about the advantages this time around. So Rachel, I'll task you with that. Share it so that those who are not there can also get that. So please, you can copy these notes, but when we meet tomorrow, we shall start on a question straight away. Remember, Sunday we have a class. The class of Sunday, we are going to discuss the time. We are going to discuss time when we'll have that particular class. Otherwise, I wish to stop there for today, so that those people who want to write can write. Then we meet tomorrow at 11. Thank you. You can log out.